Hello everybody, in this module we'll look at the ratios that concern the solvency of a company. So in this module we'll cover the three aspects of the solvency: short-term solvency, its operating cycle, and the long-term solvency. This type of solvency is basically an issue for the short-term creditors and is usually compensated on the working capital of a company. Current ratio is the ratio between the current assets and the current liabilities. If this ratio is less than 1, that simply represents the firm has a high market power, either from the seller side or the buyer side, or from the both, otherwise the company might be in a big trouble. Quick ratio is actually also the current assets by current liabilities, but here in current assets you remove the inventory side, inventory part. A software company which does not have to deal with a lot of inventories will definitely have the current ratio equal to the quick ratio. But the companies which rely on inventories for their developed products and the sales numbers affected, they are highly vulnerable to the quick ratio. As you can see here in the chart, that the current assets is 7K, all the numbers in millions, and the inventory part is 1K, so your quick asset part will be 6K, which is current assets minus inventory, and you'll get your current liabilities, that's mentioned, 7K, and the ratio, quick ratio, is usually quick assets by current liabilities, and you get it to be 0.8. Expense cover is the measure to look at the liquidity from the point of cash. Just as to meet the production fluctuations, we have inventory. Similarly, to pay out the market and the maturing deals, the company needs to have the cash, and it's a measure of the cash cover. The figures given in this chart can be calculated by the ratios presented before. Apart from the short-term solvency positions, company also earns some profit and cash, which brings liquidity by selling its services and receiving the receivables that it has to receive from the market. This is the measure of receivables that a company collects. And the time period taken to collect the receivables is a measure of great interest for the investor. As you can see in this case, the company has just the 10 days of average collection period, which signifies a great market power for the company. After generating the cash and the product, you need to generate the inventory, and this signifies and deals with the inventory turnover and the time period it takes to do all of it. We observe here that the for-company inventory holding period remains for 7 to 8 weeks on average. The account payable turnover, this deals with the time a company takes to pay its creditors, and usually the strong companies want to keep this tenure long and the collection of receivables tenure short. As the chart suggests, this is usually greater than 7-8 weeks, much greater than 7-8 weeks as for inventory collection period. So the longer the cash conversion period is, the longer and the more resources the company needs to keep its net working capital running. And the negative CCP represents that the company has more cash that it can invest anywhere else. As the chart represents of a strong company which really has negative CCP. The long-term solvency measures the ability to meet long-term obligations that are on the verge to mature. And here are the following ratios concerning them: debt to equity ratio. And as previously the formula showed, you can calculate it and get this chart. And this ratio means for every single rupee of the shareholders' fund in the company, there is a claim of 3 rupees of an outsider. And who stands the claim bigger than shareholder in the share of the owner's equity? That is the lender's claim. That has the bigger claim than the shareholder's claim, and it simply depends on the risk taken. This ratio shows how significant is the claim of lender to the owner equity. Debt involves risk and carries the fixed commitments that may lead a company to a bankruptcy position. So the company's operating profits should be significant enough to cover up the interest that it has to pay for the debt it has taken, and this ratio deals with all of it. This deals with the measure of owner's ability to command resources for the company. And that's it. We're up with the solvency ratios. Thanks for watching.